Dan, it's great to see you. You get the Barron's treatment this weekend, a new piece, and the headline is Why a Bearish Money Manager Likes Gambling Stocks and is Ready to Dump Apple. It essentially puts into print what you've been telling us for several weeks, and that is that you were net bearish, yeah?
Yeah, I mean, it's pretty much the summary. I think, what I've said consistently when I've talked to you in the past is we have two fundamental theses we're sticking with. Don't fight the Fed. Worked great on the way up for the last 13 years when the Fed had your back ever since the global financial crisis. And now you should respect it on the way lower because the Fed, as they told you and reminded you again at Jackson Hole, is nowhere near done. And the thing that was most interesting is they said in that speech, Jerome Powell talked about inflicting pain twice. And then the last piece of it, which you're starting to see now, is don't fight the fundamentals because earnings are starting to come down for the first time in 2 years. And you heard a lot of companies talk about it this week that are off quarter, that have July quarter ends. And so those are the two things you want to stick with. And the final piece, obviously, is the risk you're taking on as measured by valuations, which are still incredibly high relative to where inflation is today.
All right. In this Barron's piece, Dan, you say back in the 2001-2002 downturn, you had about 5,000 internet companies, public and private, go bankrupt. And you say we haven't seen that yet. Are you looking for that to happen this time?
Yeah, I'm expecting a wave of bankruptcies next year to start kicking in because the one thing, and we've got some charts on this on danniles.com that go through this, is during the pandemic, consumers massively deleveraged because you were getting a lot of checks from the government that came out. And the corporations, though, meanwhile, raised a lot of debt because interest rates were so incredibly low. So they actually levered up during this period of time, which is a huge problem because obviously with rates skyrocketing this year, they're going to go up more as this year goes forward. You're going to see companies that especially have floating rate debt going ahead and having a big issue as those reset quite a bit higher. So that's not a problem this year. But I think as you get into next year and you combine higher rates with slowing economic growth and inflation that's still uncomfortably high, you're going to have to deal with that.
All right. So let's talk a bit about your playbook. I think, if I'm not mistaken, 25% cash. The piece mentions you being ready to sell some Apple, but I also noticed you're long some names like Amazon and Walmart. Walk us through some of the large plays.
Sure. I mean, I think Walmart and Amazon, and Walmart in particular, are what I consider defensive long. So if you go back to 2008, the stock market S&P was down 38% that year. Walmart was up 18% that year in terms of its stock price because as people get more economically sensitive and the economy gets tougher, people start to shift down and go shop at Walmart. And so that really helped them. Amazon today, obviously multiple a lot lower than where it was in 08, 09, but I think you're going to see the same thing where people go, wow, I can't get it at other places. I can go price shopping on Amazon and get it for cheaper. And so I think you're going to see them pick up an increasing amount of share as you go through a downturn as well. And the nice thing is I can match those, like every long I have is matched against a short. And so I can match those against shorts in the enterprise software space or in the advertising space, internet advertising space, where I think estimates, particularly in enterprise software, have a lot further to come down, because that's the last shoe to drop is in that and in cloud computing.